Welcome to the Gray Report. It's time to get real. Things are not great out there. We've got a new statewide rent control law that just passed in Washington state. Sentiment, whether it's consumer, investment, domestic, and international, is all turned deeply negative for the economy and commercial real estate. It also, the near term, the right now, the apartment fundamentals, while they're better than they were, they're still really not where they need to be, and not enough to get a lot of these deals that have been really suffering underwater to a point of salvation. Well, we've got all the research, we've got all the reports that you need to be aware of to make some informed decisions, because with this uncertainty, with this volatility, you know that there will be some opportunities that arise, whether they're today, 6 months, or a year from now. You got to be ready and have a pulse on it. Well, that's what we're going to do today. We've got a great slate of articles, joined by Dr. Matt Bosnagel once again. I'm back in the seat after taking a little bit of a hiatus. Glad to be back. All right, let's get into it. Welcome back to the Gray Report, Matt. How you doing?
It is. It's been another exciting week. Things keep changing, and changing in different ways. But man, when things are so uncertain, it just seems like every week is a new week.
Yeah, it's what keeps us young, or ages us very dramatically.
Yeah.
One way or the other. But it is interesting, nonetheless. Matt, I'm really excited to be back in the seat. I had to miss the last several Gray Report recordings due to illness, some spring break. Here, there, but I'm back in the saddle.
Good to have you back.
Addison did a great job. Jay did a good episode a couple of weeks ago. So appreciate you guys keeping things moving, the ship afloat.
It's easier to be on this side. You can kick back and let you host.
You think it's easier being here or there?
No. I almost got used to it, but I think it's a little easier just to be on this side is a little easier.
You like the glory?
Yeah, that's what I liked. No, I appreciate the support role. It's way easier.
No, you're doing most of the heavy lifting. All right, Matt. Headline that came across the desk this week. It's not shocking. The West Coast will be the West Coast, but Washington State just passed universal statewide rent control.
Yeah.
And the first thing that came to my mind is, Washington, have fun having your rents go up.
Yeah.
Because in all of the markets where rent control has been imposed, the rents have gone up. And they're some of the most cost burden from a housing perspective places in the country. Now, you could say that's why they have rent control, but most of the cases, rent control hasn't improved it. And you just said right before we press play is that, and it's really true, people want to be able to have some sort of sense of control. You see their lives out of control, especially if you're in a position of where you're struggling to make rent payments. Your life might seem out of control. And if you can have some sort of predictability, or at least the idea that you may see some predictability, that seems like a worthwhile endeavor. But, good intentions lead to unintended consequences. And that's what we've seen in every single example of rent control as it's been rolled out.
So why do they go up? We're controlling the rent, so they don't go down. Why does rent control go up?
It comes back to supply.
Yeah.
And demand. So if you are a developer and you're looking at building some new multifamily properties, and you can invest in two markets. Let's look at State A versus State B. State A has no rent control. It just relies on the market to determine the rents. You build it. If there's enough demand, you lease it up at the rents that you're advertising. If you overshoot those rents, no one's going to lease up, and so you're going to have to lower your rents to be able to meet where the market is. In those environments, and if it's easy to build, a lot of developers build. There's a lot of supply, and so rents actually stay low. That's why Austin, Texas, for example, has had negative rent growth over the last couple of years.
Okay. In
markets where your developers are disincentivized because they're going to be somewhat limited on increasing rents, although the details of this legislation exclude new developments for, I think, 10 years.
Yeah, like 12, yeah.
Regardless, it's the idea that how many buyers are going to be excited about investing in a state that limits your ability to increase rent. Now, so the details of this bill, are nuanced. And I think proponents of it can say it's reasonable enough.
Yep.
It's relatively broad. For example, it limits rent growth to I think 7% rent increases plus inflation. So they're basically saying that that's going to be around in today's market around a 10% rent increase, and say, well, that 10% is a big rent increase.
Yeah.
Additionally, again, it excludes new developments. New developments can increase the rents for the first 12 years, and it doesn't apply to new leases. So this is really only applying for renewals. All of that sounds reasonable enough, except when you get into the particulars and the specifics of where you could have a renewal that someone's been paying, let's call it $500 a month, because there are still apartments like that here in Indiana that you're paying maybe $500 a month. They're not great apartments.
Yeah.
But let's say market rent's $1,500. At some point, if someone, I guess the question is, does someone have a right to stay in that apartment indefinitely, and they can only have their rent increased, call it, by 7% a year?
That's the first thing that I thought was from a renter's perspective. If you've got a nice place, you might as well grab them while they're hot.
Yeah.
Because it's really going to incentivize people that are maybe living in buildings that are new now, or just create this kind of entrenched population that's not going to move as easily as they were before. Because if they're in a nice place, that's actually where the cost of living is increasing, but they're remaining static, and maybe there's more amenities that are growing up around them, and they are able to maintain that same rent growth, and that's pretty great. I thought that in general, now the other point that was made by Jay Parsons in a separate post about this was that they do allude to it at the very end of this New York Times article, is that 7% figure is negotiable, right? If it's arbitrary to begin with, maybe if rents do increase up to the 7, every year because no one's building new apartments, then maybe they decide, well, okay, let's get this down to 4% or 5% or whatever. I don't know how that would shake out. And I do think, the 12 years is a lengthy amount of time. That would mean, I think that would incentivize development, maybe not, but it would put a clear timetable on when the investors have got to look for the exits.
Well, that's the challenge. So it may not be on the developer itself that's going to miss out on potential rent increases, but they're eventually going to sell that at some point. A lot of developers might build it, own it for 10 years, decide to sell. That next buyer is going to be limited to how they can.
Yeah, and so when you're selling that after 10 years, you're selling it on like, this is as much rent growth as you can get, or you're selling. Yeah, and I don't even think that. So this is important to note. Rent growth was 9% in Q1 2022. That was year-over-year rent growth was that. Year-over-year rent growth in Q3 2007 was 7.1. And then year-over-year rent growth from like 2015 to 2016 was about 6%. So it's not unprecedented, but it is possible in Seattle. I remember the whole story of the pandemic. Seattle had very, very, very low rent growth because it was just one of those places that had probably built a lot.
And people were getting out of cities.
Yeah, that's true. Yeah. Especially the tech. There was a remote working thing.
Yeah.
So there is variability, but to remove the chance to maybe make up for that, right, is one thing in your Excel spreadsheet that's like maybe it's 1 or 2% risk that you'd rather have it than you wouldn't. So I don't like the idea of people just completely ignoring a market that may be pretty good. Like if I'm the only one that building there, but it doesn't. The math is not in its favor at least.
Yeah, the math is we're basically saying like, okay, what is the true problem that we're solving for? It's for relatively extreme events.
Yeah.
But so the proponents could say, but it's all pretty reasonable. And I don't necessarily disagree. Like the details of like, usually you're not going to be raising rents on renewals more than 10% every year. Like, okay, that's fine. So does it completely kill the market? Maybe not. It certainly doesn't help it. It doesn't help. It doesn't increase the amount of housing supply. But worse than that, it creates a paradigm in a system that allows for price controls and for rent control.
Yep.
Because there's, like you said, now that this infrastructure and this precedent is in place, there's no reason why those rent increases might not be able to be decreased in future years. That it gets amended down over time to 5% or 3% or 2%, and all of these metrics are being made relatively arbitrarily, by politicians, by tenant rights advocates who, again, all good intentions, I'm sure. But they don't necessarily. They're not thinking about the downstream economic consequences and incentives that actually lower housing costs.
Yeah.
Empirically, we've seen it over the last couple of years in the Sun Belt, in Austin, compared to markets that have rent control. And so it's a little offensive to everyone who, believes in science, believes in logic, and looking at empirical data in case studies to show that, rent control specifically over time, since it's been tried, over the last, 70 years, has failed in almost all examples. And so we're trying basically the same type of thing again because it makes us feel good. And what you said earlier is that it gives us an illusion, an absolute illusion of being able to just control
the impulse is to control.
Yeah, exactly. 100%.
But I'm also thinking that it may not kill the housing market. It's just going to make it a whole lot different. And
like California, housing market isn't destroyed.
Yeah.
It's not good.
It's just, exactly. It's just way different. It's subject to way different dynamics that make it a little harder to build and a little less reactive to housing demand in general. And I'm thinking of New York right now. New York's rent growth has been relatively decent recently, but again, it has a stigma among, and it's its own special market. And the same thing kind of with San Francisco. It's its own special market, and Los Angeles a little bit too. The question is Seattle going to be? Does Seattle have enough of that kind of specialness, or is it going to be seen as an alternative that builders would rather not build in? I'd be really curious. I think that there is it's interesting. The story of this law is that in 1980 they put the previous law that was on the books was a Republican-controlled state legislature, and they said no bans or no rent controls.
Exactly. The last time they actually imposed.
Statewide
rent legislation often is to limit local municipalities from imposing rent control.
Yeah, exactly.
Yeah.
And so this is way different. It could mean that people with a specific business plan are able to get in there for, let's say they get in there for the first 5 years, and then they sell it for the next guy that's in it for the next 7, and then I don't know what, but that sales price at that 7-year may be lower, which means that the sales price that he's willing to buy it may be lower, which means that the development cost may be a little bit lower. So it cascades down. At the end of 7 years, if you know that at the end of 7 years, whatever apartment building is going to be a little less attractive than other apartment buildings that are built without rent control, then you're probably going to factor that in at the very beginning, rather than saying, you can't assume that the guy that buys it from you is not going to know that too.
Yeah.
Very interesting. It will be really super interesting to see what develops in there, because people were building like crazy in Seattle. I was there a couple of years ago, and there were still cranes going up. We'll see if that momentum continues. It's a super interesting, especially in the wake of what did they say? Oregon and California had both put in rent controls, and this is the very last paragraph of the thing. It says at the tail end, it says the cap at 7% plus inflation rate is in place in Oregon, and it's 5% plus inflation in California. Both states set a maximum of 10, but there are efforts in both states to lower those caps.
There we go. Yeah. There we go. It's it's sad because California, Oregon, and Washington, all just absolutely beautiful states. All states that I would love to live in, but between rent control and gun control, that's just not an option.
Yeah.
So it's too bad. Let's turn to sentiment, Matt.
All right.
Sentiment's not looking good. Whether it's consumer, whether it's investor, domestic, or international, sentiment has taken a turn for the worse. Yeah. And so we have the most recent U.S. Consumer Confidence survey from the Conference Board. Confidence absolutely plunged in April. Post-Liberation Day, the data is in, and it's not good at all. We're talking about a drop almost akin to levels that we saw last during the pandemic. Now, we weren't at a point, we didn't fall from as high of position prior to the pandemic. We kind of reverted to the mean. But man, basically since the beginning of the year, it is a very stark drop off. Basically, we were kind of in that mid, 110-ish range. Now we're down to 90 or so. It's not good. Not as low as it was pre or during the financial crisis. But we also kind of started at a similar place prior. So
Yeah. It's also notable that this is this downturn is several months in development. Like especially the expectations, it's been going down for at least this is not the first month that it started to plunge. It was going down for the months that preceded it.
And really since interest rates started hiking, or the Fed announced that they were going to start hiking interest rates, that was really the turn. I mean, we saw kind of peak confidence, kind of the period of like still in COVID, but getting out of it, but before interest rates were started to be hiked, there was a lot of exuberance of like, we're just okay, soft landing, we're getting out of this COVID thing, everybody's making money, things are good, and then things started getting a little bit more expensive, and the Fed had to take some action. But apparently, it was not a transitory inflationary situation, although it was just not as short of a transient as some folks would like to have seen. Looking at families' current financial situation, talking about, is it good? Is it bad? Well, it's getting less good and it's getting more bad. The bad is up to kind of a 23-ish, up from kind of a 18. I'm kind of reading in between the numbers here. And then the good has declined, kind of peaking like 31. Now it is kind of like 24 on their scale of percentage of folks, their opinion of their own family situation. For both current and expected, the family's financial situation is going down, and that was not necessarily like an outlier, but among the entire report, the sense was, all right, things are okay now. It's a shaky kind of okay, but things are okay, not going down dramatically. But then their expectations 6 months hence is they went down on almost every category, but except when it comes to the labor market, there was also a decline in both categories. And of course, Matt, we've got to look at the perceived likelihood of a U.S. recession over the next 12 months. And this is critically important because, our perception of what we perceive certainly can turn into reality.
Yeah.
And we can will a recession into existence quite easily. And we're already seeing a lot of that behavior, regardless of how the underlying fundamentals actually turn out, regardless of how tariffs and trade and interest rates actually end up working out, or inflation. If we want a recession, we'll stop spending money. We will stop spending on goods and services. And we're already seeing that happen. Vegas, again, anecdotes like, Las Vegas bookings are way down. Travel is way down. We've had companies that are starting to pull their earnings estimates, right now. Pulling back on spending. Businesses are more reluctant to hire, and families are more reluctant to make large financial decisions. And so just that in itself, and the anticipation of the bad times to come, could bring the bad times on themselves.
Yeah, it's interesting to see how that it was similar. It was a little bit higher actually in about like May of 2023, and I'm wondering why.
Well, I can tell you why. They read our loan maturity report. But I mean, this started shifting basically as interest rates were rising. The idea we were talking about at the end of 22, really beginning of 2023 was the Fed was going to hike interest rates to rein in the labor market, to potentially purposely cause a recession, to bring inflation in check. And we didn't really have that full recession, although we did have 2 negative quarters of GDP growth. But technically it wasn't a recession because other reasons. But now, it's back up there, not for interest rates, because the 10-year has basically been hanging out right around kind of 4.2-ish% in a range of call it 4.2 to 4.5 maybe someday.
Okay.
Fed funds rate, obviously the Federal Reserve hasn't lowered rates yet, but Fed funds futures have been coming down with the idea that this slower growth could potentially lead to a recession and force the Fed to bring Fed funds down even lower. But again, further complicating is this idea that tariffs and a trade war may be much more inflationary. And so then do we enter a real stagflationary environment where we have high inflation, but growth is really slowing down? And the textbook response to a stagflationary environment developed by Paul Volcker is to increase the Fed funds rate.
Yeah.
So that would not be fun for anyone.
Okay.
We saw last time that happened. It basically everyone thought it was going to put us into a recession.
Mm-hmm.
And it certainly is not going to help out CRE borrowers who are looking for a reprieve from loans at the current state they cannot pay back.
Oh, yeah. Very true. It's worth seeing how all of this consumer confidence plays into the perspective of renters, but it's also, it's a powerful sign of what investors might think. And like it follows on the very same causes that are shaping the the debt market in commercial real estate.
True.
It may not, consumers may not know specifically what's moving it, but like the aggregate is, it follows, it's very highly correlated, it would seem.
Yeah. So the Association of Foreign Investors in Real Estate put out this survey, and let's talk about some of the key findings. 63% of investors have a negative outlook for U.S. cross-border investments, despite promising fundamentals. Mm-hmm. That is up from 42% that had negative outlook back in the fall of 2024. So things have gotten worse.
Yeah.
But what's interesting is 44% of non-U.S. investors plan some level of increase in U.S. property investments versus the previous year's 24. Yeah. So it's basically double the number of foreign investors that want to invest in the U.S. despite having a negative opinion or outlook for U.S. cross-border investments. 30%, some of these takeaways are interesting. 30% agree that pressured by climate-related changes in quality of life, as well as the rising cost of climate risk, population growth in the southern states over the next 10 years will decrease and the northern states will increase. And that is up 14% who agreed in 2024. This really kind of stood out for me as coming out of left field because we have talked about it and on more of like a longer range.
Geologic.
When we're talking about the Midwest, we're like, well, we don't get all the weather-related events. We don't get hurricanes.
Yeah.
There's no earthquakes.
But in 50 years, we may be able to grow coconuts on the shores of Lake Michigan.
And then we're okay. If climate change has the impact that is discussed, then the Midwest is kind of, it's not a good thing for the world, but the Midwest, it might be a little bit more temperate and might be able to grow more things, longer growing seasons, not the end of the world, have a lot of natural resources. And they're basically saying that it's just going to be too expensive to live in the southern states, and so there's going to be some migration to the north. Not only that, but the southern, this is not in the report, but the southern states, as people have been moving and continue to move down and will be for the foreseeable future, it's getting more expensive.
Yeah.
It's getting more expensive as more people move, and therefore the affordability, which was an original driver of going down to the south in addition to the warm weather, the north and the Midwest is going to start looking attractive because it's going to be cheaper and more temperate and no hurricanes.
I think that is maybe the most interesting. It would be like if the cost of insurance. If exactly. If we're factoring in hurricanes and just like extreme weather and other things like that, that may be a factor. But like there are some places in the South that don't have hurricanes. So is it like air conditioning or or maybe it's water? I think that actually, if we downloaded the full report, actually water was one of the issues. But it is interesting that 30% think that in 10 years, and maybe on the margins it does change a little bit. Who knows?
Yeah, they may be putting a little bit too much weight on the climate effects.
Yeah.
I mean, it's certainly real. They may be using Al Gore's numbers from the 2000s that put a couple cities underwater maybe by now, but definitely a factor that is real, but maybe getting over the skis a little bit.
It also looked at the most preferred markets for investment, and there was no
classic international responses. Primary and gateway markets. They have not heard of any of growing secondary markets, and this is why these markets get overbought and can be expensive, and the returns are so low because you have these big foreign investors coming in who are like, where do you want to invest? And they're like, well, where have I heard of it? Well, I've been to New York City. New York City seems like a nice place.
Yeah.
Los Angeles, I flew in there. Nice airport. Looks like where else would I invest? There's more to the United States. And they're like, Texas, big state. Everything's bigger in Texas.
Yeah.
Dallas, just good show.
Yeah.
I'm not saying there isn't more nuance than that.
It's the top ones. And
exactly.
San Francisco's
what do you
in there.
know? And so, they're like Indianapolis, where is that on the map? Cincinnati, Kansas City, what do when I've talked to some international investors, when I've told them about the Midwest, sometimes I get a perplexed look, and I've gotten responses like, "What do people do there?
Yeah. Yeah.
Why what people exist? What do the people in this region do?"
I understand that a lot more than other places. We've got farms around. At least we're farming and we're living and we're eating.
Farmers. You're farmers.
And we're all farmers. That's
farmers.
Why that makes sense. I see all these farmlands. Okay. Some places I don't even know what they do. There's no farms around there. I don't understand it. What do they do in LA? There's no farms there.
I don't know. It's a great question. I guess that's why people are leaving.
Yeah.
Okay. So sentiment not great. Although foreign investors are slightly confused as they don't think it's good, but they do want to invest more. And that kind of piggybacks off our discussion from a little while ago about the devaluing of the U.S. dollar, the dollar getting weaker, and at some point, do U.S. assets become attractive? Right now, people, there's a little bit of a screw the U.S. trade of just you guys are making things complicated, these tariffs, and you guys want to invade Greenland or whatever. We're not going to invest in U.S. assets. There will be a point of where they're going to say, those U.S. assets are starting to look pretty good, especially if they're at a discount from a weak U.S. dollar, and if there's some valuations decline a little bit more. And that's in all forms of U.S. assets, preferably, the U.S. bonds, which is the biggest concern right now, with just the lack of interest to purchase our debt, but, real estate and real assets also. But again, the reality is you have to look around in the reasons why the United States has been a safe haven is, you can argue maybe this is changing, but where else do you go for the same type of stability?
Yeah. Yeah, no, and that's what I was kind of thinking too. Is maybe they're looking for an insulated asset, something as a little bit of a sanctuary from global economic upheaval, and it's worth noting too that multifamily is the sector that they're most interested in investing with.
And I've been hearing that anecdotally more and more, in the sense that, man, some stabilized cash flow in multifamily sounds pretty good right now.
Yeah.
If you can get it, if you can find it and buy it to where it cash flows. It sounds pretty good right now. Now, do you have to deal with a recession immediately? Maybe you do. If you buy it, they can suffer. The property can still perform if there's a little bit of a rent dip, and still pay the mortgage and put some cash in your pocket. Sounds like a pretty good place to be, especially when that market recovers, because markets always recover eventually for that upswing.
Yeah,
which is pretty fast.
Very good
point. It doesn't
point.
always take too long.
Yeah.
Let's talk more about the apartment market because I've been getting so excited for spring leasing season. And it really starts kicking off. It started in April. January, February, they're pretty slow. The winter months are the slowest. December is the absolute slowest. January, things like there's a sign of life. February, it's not good business, but people are signing leases. March, people are waking up. April, people are moving.
Yeah.
By June, that's typically, every market is a little bit different. June is typically the peak where you're signing the most leases, and it's the month where you see the most rent growth. So we've been following, the last couple of years, because they've missed some of the seasonal. The seasonal trend was there, but it was significantly subdued.
Yeah.
Not that much rent growth in the summer, but certainly not enough to make up for some of the declines, especially in the southern states during the fall, winter, and spring months.
Yeah.
In general, and I'm just going to skip ahead, Matt, to this is fine. United States median rent between 2017 and present. If you look at this graph, not to get too technical analysis on everybody, but it's lower lows and lower highs.
Yeah.
It's not a great trend, but you can see that oscillation between the strong leasing season, the slow leasing season.
Well, you look at it right now. It looks like a long-term growth trend pre-pandemic, and then post-pandemic is just a long-term trend of decline that may be flattening out, arguably, but there's no real way of knowing right now, especially with the numbers that we saw this month.
And where we've seen, if we go back to 2019, where again January basically was negative, but then February a little bit of growth, then March, April some really strong growth. It really pretty much grew until it peaked out in basically, again, June or July, and then you start seeing a little bit of declines to a period of a little bit of negativity. We kind of missed out, in April. March, we had some good growth. We were kind of on trend, similar to where we were, a little bit better than 2024. But April, really, things started falling apart, somewhat how they did last year, but a little bit more. So the question is this negative sentiment that's seeping in? We're not seeing the growth, certainly not the recovery. Or is this still, we're dealing with the hangover of the oversupply? We just built more apartments than we have since, basically 40 years ago, when supply was peaking in the 80s. Are we vacancy rates are also peaking to higher than pre-pandemic levels.
Yep.
It's just this, is this just getting out of supply? Is this potential fears of recession and hard to make decisions? What's your take on the lackluster, unexciting growth, but growth nonetheless?
I think that at this point, it's probably still the shaky supply situation. We're coming off of a great deal of supply. I don't think the economic uncertainty is hurting it, but I have a little bit of trouble thinking that this uncertainty. We just saw the consumer reports where people's present situations were okay.
You would think people are going to renew. They're not. They'd be less likely to go and look for a new apartment.
Yeah. So I'm a little bit. I would be unconvinced that of the past 3 months that sentiment has really impacted the apartment market, but especially considering that during the pandemic it really took a whole lot, took the shutdown of everything ever, and it really and even going back to the great financial crisis of 2008, where rent growth was not as affected as other sectors, it's still relatively insulated, I would say, from what you see in the stock market. I think that
there was a little bit of rent. There was definitely rent decline during the financial crisis.
Yeah.
But it bounced back in a big way, and it wasn't a huge fall off.
And what I should really say is it's probably less reactive than the stock market. These rent growth numbers, and are probably the result of supply. But I think it makes it more vulnerable. And if you're chipping away if you are leaving people vulnerable when it comes to supply, then their economic uncertainty may show up a little bit. It show up on the negative side too. Because I made the point a month ago, now if once supply kind of equalizes with demand, job growth is going to be a factor. Well, right now job growth is a factor, but it's in the negatives. When I was maybe had rose-colored glasses on, I'd think job growth as a positive. But now I'm even reading headlines as I was gathering data for this report that job growth you can't really count on that now for rent growth, and it's partly because of supply, but partly because everyone's in this wait and see. So that's I think that also, and I was noting this too. I think my whole point that I had really in January is that we may see the same amount of rent growth in 2025 as we saw in 2024. I think that's probably the bigger thought that I have here is, as this supply environment improves, as things do come into a balance in a way that's would be arguably better than 2024, we're still probably going to see the same rent growth, because maybe that will be equalized by the uncertainty that people have and this kind of stay put mentality.
We still have to kind of wade through the supply. So, Matt, let me ask you this. We're talking national numbers. How helpful is talking about national averages, national mean? Because we know that the different regions, different markets are behaving so differently. So, could you just talk a little bit about some of the differences, and why even look at the national numbers? But,
I know, it's a good point.
But tell us about some of the differences.
I think that we can scroll down to get their list of the top markets. But I also think this is another refrain that I've been calling out is, I think we're going to see a continued divergence of the top performing and bottom performing markets. But as we talked about many times.
This is an interesting metric, Matt. Not sorry to interrupt you, but their list to lease index comes down from an all-time high. This is the time it takes to lease. How long an apartment sits on the market on lease?
Yeah.
So it's been at an all-time high, but it has come down slightly.
And I wonder if this is
trending up.
Yeah. So it is trending up, and it's come down from that peak, but there's generally a peak in January. So you don't, you never know. And I'd have to read this like sine wave here to determine where where the trough is. But I think that's interesting.
Yeah. But yeah, let's go to some of these markets. As you can imagine, falling rents in the Sunbelt markets, specifically Denver, Phoenix, Salt Lake City, Raleigh, Jacksonville, San Antonio, and Dallas.
And then
let's go. Here's the list.
Yeah, and then
New York City, top spot, by the way.
And it's 4.9% rent growth. This is what I was saying. It's like it's not out of the question.
Maybe rent control is a good thing.
it's I don't know what the cause and effect.
Looks like it's really helping out New York City.
It is helping out some landlords that are enjoying year-over-year rent growth. It may not be helping out the renters rent control that would rather spend less money on rent than and have more have more buildings out there for them to live in.
I mean, New York, Los Angeles. Not Los Angeles doesn't have too much rent growth. It's 0.1. We're just looking at these are big markets.
Yeah, I think there's sort of this one by population.
Oh, that's no good. Let's do a rent growth.
Yeah, but I think that regardless, I think New York City is ranked among the top ones here.
It definitely is. I can't seem to get this widget to work.
I think they have it in the paragraph somewhere up here. They talk about how the Midwest markets like Kansas City and Chicago are strong performers, and it's right. So if you keep going below, there's a big blank spot, and then there's that paragraph where it says markets across the North. Providence, Rhode Island's doing well. Washington D.C., Chicago, Kansas City, those are all doing, I think, really well. And as we noted, rents are growing in New York City. It doesn't mean in New York City is at least part of it has rent control, and so it's a complicated issue. It doesn't mean that it keeps rents down below everything else. It means it has the mixture of rent control and apartment supply can sometimes come at the expense of the renter in some cases. Now, in harkening back to that New York Times article, it's funny they had the case for and the case against, and even in the case against rent control, they carefully noted that yes, there is a case. It used to be widely accepted. However, some economists now are questioning the long-held belief of rent control being a net negative for the relief of housing demand. So I'll have to look up those.
I don't believe I haven't been able to find an economist who thinks it's sound economic policy.
Yeah, I'll chase down those links.
Plenty that think it's a horrible idea. I mean, it's basically it's price fixing.
Yeah,
and usually a central figure. The state government doesn't exactly know the best prices.
Yeah. There's an intuitive idea. I think I'm going to read into and see where they're linking on these on the objections to this idea that rent control is not necessarily the best thing because maybe there's not one solution. Who knows? I'm not exactly against it. That's why I thought if you're in Washington and you have that plan for those 12 years, great. But I think it complicates things and it creates some uncertainty for the builder, uncertainty maybe for the renter, but you can't react from uncertainty to try to grab away someone else's certainty. It's just kind of there's a way to go about these things, and I don't know if it's with more government control over stuff.
Just over-regulated industries don't tend to get cheaper.
Yeah,
and if the goal is to make things less expensive, over-regulating isn't going to be the solution.
And it does expose the fluctuations. It makes things unpredictable. If instead of, and maybe it does make it cheaper. Who knows? But it does make it more unpredictable because if I'm a landlord or a renter, I know what rent growth, or I know what's going to happen. That if it's market forces, and I can study the supply trends and say, oh yeah, rents are getting cheaper, nothing's going to be happening that's weird here. But if it's determined by government's in charge, they could change things one year for the next. You kind of don't know where the lines are going to be drawn, especially
whether you're a renter or you're an investor.
Yeah.
I'm going to invest in Washington today because I understand what the policy might be, but as we said, California's looking at changing it. Don't mean to go back on that article, but this is a really good apartment list piece. going to be continuing to look at that days on market, that data set. That's going to be interesting to continue to track and see if that changes. And we'll be monitoring on a week by week basis, more than just month by month, on to see if we see a pickup in leasing velocity. I mean, and again, we really will have to break it down. Really need to break it down market by market because just in the Midwest, the markets we're in, I mean, they're different. We have some markets like Bloomington, Indiana right now. There's a lot of new supply that's been coming online. It's been relatively soft. Indianapolis, it's been kind of past the supply peak. We've seen a good amount of recovery. We're seeing some strong rent growth. Seeing strong rent growth in most of our markets. South Bend, Terre Haute, up near Lansing. Evansville, good, solid rent growth. It's the whole nation, though. It's not exactly the same.
Yeah, totally. I think that in general, the Midwest has been outperforming the market, and in the Northeast too. Midwest has been more consistently kind of the leader if we're talking about regions, but it is we're talking about like Midwest maybe 3% rent growth, and then the South and the West maybe like -1%. So there's a big difference between the rent growth even on average in these regions. And that's kind of erasing some of the higher and lower performers.
Very true. Any other?
Yeah, I want to talk just really quick. If we can get into this Collier's article. This is really interesting to me only because. And I love this. I love this point that they make. They're talking about loan maturities, and they say loan maturities remain a constant refrain, and I really. It almost triggered me a little bit. I was like, well, yes, we've been refraining it. But it's also this idea that, and I think that they're trying to imply this, they're saying that it's such a constant refrain that it is just background noise, right? That you can't even, maybe it doesn't even exist because 2023.
It's fugazi. It's fugazi. It's out there. It's here. It's there.
and like that's what I wonder if they're meaning that, or alternatively, and this is what I think it's a drum beat. It is a refrain, and the Viking ship is approaching. And so that is this big question mark. I really appreciate it. Aside from their editorializing, they do give us exact numbers. So of all of the maturities that are coming up in 2025, just a little bit over 30% of multifamily maturities are extensions, basically. So that's coming off of an extension, 31%, let's say, of multifamily loans. And that's a decent chunk. It's not as high percentage-wise as
there's other
sectors.
maturities, that are stacking on top.
But, there's so this is... It's going to be
in other words, 30% of loans that were maturing a year or two ago had to be extended.
Yeah, very good point. And have things dramatically improved since then? I don't know if they have. I don't know if interest rates have, and I think that was probably the biggest thing that they were thinking about.
Depends on interest rates. It really hasn't. I mean, Fed funds has come down slightly, but not meaningfully enough. And you're still, if you're going to use floating rate loan, that's kind of points you in a certain direction. But from a rent growth standpoint, I mean, it depends on which market you're in. And then expenses, we have properties that have had nice income growth, but we've had expense growth that has kept, NOI growth, positive, but much less positive than if we didn't have all the expense inflation. So I'm thinking about folks in like Austin, Matt.
With what kind of properties?
Yeah, well, value C class, B class, those type of stuff. That like demographic issues, you can't collect the rent, your payroll's gone up, your expenses are gone up, property taxes gone up, insurance has gone up. You're having to pay your people more, and you've got these tariffs you're gonna have to be paying more because you're trying to fix the place up. And rents are down 15% to 20% over the last couple of years. You're on a floating rate bridge loan, and so your interest payments have doubled, if not more.
I was talking about this last week with Addison. It's like, I formed this imaginary, like, straw man kind of, but There's a lot of that. There's a lot of it. I think you go back 4 years and it was a boom time and people were doing this and people were advertising very heavily. This is where we're going. You go back to that foreign investor thing. A lot of those hot markets that they liked were in the South. Austin was on that list.
Oh, yeah, they still like they have Dallas. I mean, in Dallas, there's things to like about Austin and Dallas. It's there's also other places, and everyone had the same idea. The same thing. Whether you're a developer or you're buying, let's all go renovate these C-class apartments, put some lipstick on it, try to get $300 of rent bumps, and then let's take all the money from the coast and internationally, and let's all build in Austin, Dallas, Houston, Salt Lake City, Charlotte, Raleigh, Miami, Tampa, those types of places.
It is
all great places to be.
Yeah, and the only reason why this, except when you have a deadline approaching, and I actually think it's probably a cliche at this point from my perspective that I say, Midwest stability, we're doing so great, and I feel a little bit bad for the for the Sun Belt, but long term, it's going to shake out to the benefit of the Sun Belt. But these people that have low maturities coming up, they don't have the benefit of that time, and the big question mark is: Are banks going to say? Well, in the next couple of years it'll be fine, so you're going to be okay? Or are the banks going to say, actually, in the next couple of years it's still going to be equally shaky, so we just can't do this for forever?
I think banks are throwing in the towel. I mean, we, on our last low maturity report, we mentioned that how the New York Fed kind of changed guidance.
Yeah,
on
very good point.
Extend and pretend needs to come to an end. Mm-hmm. I mean, I think that's why. I mean, they're including in the report how much of the maturities are extensions, of how big extend and pretend is. We're hearing from our banking relationships, and that this is a near direct quote of where they're having conversations with their closest relationships right now.
Yeah,
that they've been very accommodative for.
Do you want to have this piece of property?
Well, and it's more of like, hey guys, this wasn't a permanent loan.
Oh, they're talking about the lenders. I thought they were talking about people we're going to take over this property. So do you want to take it over for us?
No. Well, there's some of that also.
Yeah.
But it's more of a lot of times it's properties we don't want.
Yeah.
Except there's a price.
Well,
there's a price.
We definitely
those properties. We've talked about this a lot. Also, they need to get to that clearing price because right now, the prices of the stuff that I like is still way too expensive. Even though the cost to build is going to be a lot more expensive in the future. So interesting basis plays, but just not great cash flow. But then you have these older properties, C-class assets that are just troubled. People don't love living in them, so unless you keep the rents really cheap, but they're hard to insure, they're harder to manage, they're harder to operate, there's less sellers. And the cap rates on those properties, fell to the floor to the same rates as low risk A-class properties in the suburbs, but the risk was not the same. And just people were like, well, we're going to put some lipstick on it and we're going to raise the rent $300 and it's going to pop it up, and then we're going to get a appraisal and they're going to say the value is worth 60% more, and then we're going to do a cash out refinance and just bust out of the thing. Or we're going to sell it to someone with telling them that they can do another value add. And get another $300, but it's like, how are these people going to be paying any more money?
Yeah,
you've got 7.5 foot ceilings.
Well, that's what I think of.
Obsolescence.
I think of how are they going to market it, basically, to
renovated luxury apartments.
Yeah, and how quickly can they do that before there becomes some price discovery in the markets where people are like, no, this isn't.
I think that's what's happened a little bit.
It may, and as and I mentioned this before, but it probably will benefit people that have a keen eye out. I wonder how quickly these opportunities are going to emerge and then go away. 30% is not a small amount of any year's loan maturities. But I don't know what percentage. There's another percentage, like how many are under special servicing and under delinquencies, which have over the past year have been slowly trending up as well.
Yeah, I think CMBS distress right now, I want to say, is at 6%, which is much higher than it used to be.
Yeah.
But it's not the 10 to 11% that it was during the Great Financial Crisis.
Yeah.
But again, at some point we could hit those levels, and it can happen pretty quick.
Yeah.
But it's not. The fire alarm's not absolutely going off, but it's a good time to make sure that it's working.
Yeah, and that may be the best
fire suppression systems. Don't have to go on fire watch.
Yeah. Well, and if you're looking, maybe you're a foreign investor that's looking for deals, or if you're just a regular investor, I just wonder how much these will actually move the market, or whether it's just going to just come up really quickly. You have to act on that opportunity, and there is a very emergent situation, and it will reward
where it could. I think that it's most likely to come off piecemeal, like you described. The only thing that could change that is if it it turns into some sort of issues at banks or lenders. And you have not the properties themselves, but the lenders, whether those are debt fund lenders, kind of private lenders, or banks themselves start having issues, even some more bank failures, similar to
because then if prices go down, their collateral will the value would be
they've made a lot of bad loans that can't be paid back.
Okay. Whew. It's gonna be exciting, and we will be on top of it, I'm sure.
It would be. I would like to move past the loan maturities.
I
think we've covered it probably closer than any outlet that I am aware of. We were probably, I think, one of the first publications to put out a report on it back in 2023. And like you had mentioned earlier, and the Collier's piece kind of pokes fun at, is that it's like it's been hanging out there for a while. What gives? And there were some comments of like, there's all this talk about loan maturities, but I ain't seen any of them. It'd be nice to, whether it fizzles out or it does have a larger impact on the market. It is certainly an overshadow that'd be good to move past, regardless of what the outcome is. And from the beginning, we've never necessarily said, "Oh, this is what's going to cause the market to crash," but it's a factor that the market's going to have to deal with and get past.
And how incredibly dramatic for maybe a minority of percentage of people that are involved. Very exciting.
Oh, Matt, I miss being here.
It's good. It's good to be in. It's good to be back, right?
It's good. It's good to be back. Breathing. Good to be back in the seat once again. So thanks for keeping a steady hand on the helm, keeping things moving.
I'll be there every Thursday in your inbox. If you go to www.graycapitalllc.com/newsletter, you'll get all of this stuff and more in your email, and also on Sunday. That's a lot quicker updates. Sometimes you're gonna have to read. I like our commentary, but then we'll provide the raw material that you can figure out a little bit every Thursday and Sunday if you sign up for that. What I see as the most glorious multifamily newsletter in the industry.
No newsletter has been copied more.
Yeah, that's right.
People like it. They copy it. They put their own out, which is fine. It's great. The more information, we don't make any money off the newsletter. We've gotten some investors who invested with us because they signed up for it. Same thing with the podcast. We enjoy it. We think it's a good service to put out some good information. And if you are an accredited investor and you decide saying, hey, these guys have a pretty good idea on the market, they're up to date speed on where the data, where things are moving, and oh, by the way, we're a vertically integrated operator based in Indiana. You want to partner with us on a project, love to have a conversation with you, although we just do this because we like to pretend like we're economists talking about the market on the YouTubes every week. Thanks, everybody. Thanks for watching. Yeah, as Matt said, like and subscribe. Sign up for the newsletter. And if you have any comments, make sure you leave them. Because we are not right all the time. But also we like some pushback.
It's fun.
And we respond.
Totally.
So, totally. All right, thanks again. See you next week on The Gray Report.